All right, folks, more amazingly bullish news for Bitcoin. This is the year of the banks coming for Bitcoin. 2026, the catalysts continue to stack up. After 15 years of treating Bitcoin like a nerd with head lice, the banks have finally decided that they want custody of Bitcoin, they want ETFs, they want collateralization, and most of all, they want yield on something that they swore was rat poison squared, and they want it now. The big news today, Morgan Stanley just came out and said, screw it, we are done pretending. Launch the spot Bitcoin ETF, manufacture it in-house, wrap it in a suit, and sell it to grandma. And with all of the massive banking catalysts stacking up for Bitcoin, we are seeing full-scale financial annexation of the asset. This is like watching the Catholic Church issue indulgences for LSD. Suddenly, everything that they condemned is holy as long as they get a cut. We have JPMorgan actively lending against Bitcoin now. We see OCC giving Bitcoin the green light. Yes, Mr. Banker, you may now custody Bitcoin. You see what's happening here. Bitcoin is becoming absorbed by the banks. They thought they could regulate Bitcoin out of existence, but instead they wanted it on client statements because you know why? The real money that's out there, think BlackRock, think Morgan Stanley, Goldman Sachs, they don't care about ideology, they care about flows. And Bitcoin is now an asset with real flow, ETF flow, custody flow, and prime broker collateral flow. This is institutional conquest of Bitcoin because Bitcoin is no longer an outside asset. It is the apex predator of global finance. And in 2026, Bitcoin is hungry. January 6, 2026, what happened? Market down the day that one of the most powerful banks on earth said, yes, we are done pretending. We are issuing the Bitcoin right now. Morgan Stanley filed for a Bitcoin ETF and a Solana ETF too, because why stop at Bitcoin when you can print a nightmare as well? But the real headline isn't Solana, of course, because we know that Bitcoin only, Bitcoin not crypto, we have common sense. But the real story is for the first time, a US money center bank isn't distributing someone else's crypto product like some bored Walgreens pharmacist pushing pills. They are manufacturing it, wrapping it, warehousing it, owning the entire product stack. And why now, you might ask? Because the SEC finally yanked the Staff Accounting Bulletin 121 out behind the shed and shot it last year. Remember that idiotic rule that treated custodial Bitcoin like it was nuclear waste? That is gone. So now Morgan Stanley can warehouse BTC in-house and slide it directly into their $1.3 trillion wealth management Death Star like it's a municipal bond. You're going to see 55-year-old estate lawyers in Connecticut allocating 3% to Bitcoin inside of their tax-advantaged trust structures. And this is what it looks like when the dam breaks. You start to see the financial elite getting tired of standing on the sidelines while BlackRock gets all of the flow. This is not about risk anymore. This is about fees. This is about centralized control. And this is about getting there before Goldman does. This is the game theory, folks. Once you see a bulge bracket bank committing capital and brand equity to a Bitcoin product, it's over. This is another all clear signal for the rest of the industry, and they continue to stack up. The floodgates are coming. They have ripped the door off the hinges, and Morgan Stanley is now the latest one, standing in the doorway with a fire hose full of BTC, yelling buy the dip. And you know what's better than number go up for Bitcoin? We're talking collateral eligibility, because when a bank accepts your asset, in this case Bitcoin, as backing for a loan, that is weaponizing the asset. We saw JPMorgan in October. They announced this new program that was going to let you post Bitcoin as prime broker collateral. That is right. Bitcoin is now repo eligible. It went from Silk Road to secured lending in under 15 years. Incredible. It mirrors the US Treasury repo market, the same tri-party structure, the same custodians, the same lawyers pretending that they understand blockchain technology while copy-pasting clauses from 1994. But the impact of this is obviously very real. We are going to see this start to happen in 2026. This program will be launching to the institutions, as well as probably similar programs from other banks. Officially now, Bitcoin sits next to treasuries and Apple stock in prime broker schedules. It's no longer volatile internet magic money to the institutions. It is being seen as very productive capital. We know that the hedge funds are salivating, the market makers are getting new ammunition, and the corporations that chase cheap leverage, now they get to recycle BTC, and this creates a velocity loop. The velocity loop entails that Bitcoin moves, and then it gets posted, reused, borrowed against, and then suddenly it's got monetary turnover. The basis spread compresses, and then arbitrage flows start to pile in, which is just more evidence that Bitcoin is leaving that speculative sandbox territory and into the structural bid territory from people with actual money. This is what gold leasing used to be, for those who don't know that, but now it's faster, it's scarcer, and it's absolutely terrifying for central banks because Bitcoin is no longer the trade. It is being seen as the inventory. It's what the funds are going to borrow against, and it's what's going to get recycled into yield. And when JPMorgan, of all institutions, they say that they are giving Bitcoin a seat at the collateral table, they are not asking for permission anymore. They are declaring that this is capital now. Deal with it. And this is another catalyst for why 2026 is the year of the banks coming for Bitcoin. December 2025, we need to remember the OCC dropped a little Christmas present on Wall Street, Interpretive Letter 1188. It says, hey banks, remember all of that hand wringing over the crypto industry? Yeah, you're good now, go wild, just follow standard safety and soundness rules, knock yourselves out. And this wasn't necessarily a soft yes. It was a state-sponsored green light. It gave a green checkmark for riskless principal trades. It gave a checkmark for digital custody, and this was explicit permission, no ambiguity, no sandbox. This was regulatory conquest by memo. And then preceding this, we saw last January the SAB 121 rule. This was the idiotic rule that forced banks to book Bitcoin on balance sheets with full capital requirements, and now that's dead, it's cremated, and it's been flushed into history. So now officially, according to the rules that are on the books for the institutions, custody is not just allowed now, it is literally profitable. Coins go off balance sheet, the capital charges vanish. The economics of Bitcoin for the institutions have literally flipped from compliance liability to fee generating core product. So what happens next? We saw that US Bank, they relaunched institutional Bitcoin custody like it was a hot new feature in TurboTax. And 60% of the top 25 US banks right now are already building custody, ETF servicing, and trading desks for 2026. This number is not a projection from me. It is literally a fact, because we are living in an institutional Bitcoin arms race, and nobody wants to be the bank that's not taking part while their competitor is issuing tokenized yield notes backed by wrapped BTC. And then you have to look at the Basel III guidance, the risk weight for Bitcoin custody that used to be 1,250%. And that is the building on fire territory. But last year, toward the end, they revised it to 100%, the exact same as equities. You might be asking, Adam, what does that mean? That means that Bitcoin is no longer treated like nuclear waste. It is treated like it was Apple stock. It's treated like a Mag 7 stock, and that's what normalization looks like. This is how an asset crosses the Rubicon into being accepted. The banks are already here. They're currently onboarding clients with a smile, a login portal, and a 20 basis point custody fee. All right, here's where the BlackRock brain kicks in, because this is not a Reddit-fueled hype cycle for Bitcoin. This is the institutional liquidity plumbing. 3 flows, 3 structural engines, all moving in the exact same direction. Permanent, recurring Bitcoin demand. And first are the wealth management ETF rails. So the bank-run ETFs are now integrated directly into the same portfolio tools that manage $33 trillion in US advised assets. That means advisors can now click a checkbox, balance a model portfolio, and auto-route dollars into Bitcoin without even telling their client. And if we're talking 1 to 2% of that total platform, that is $330 billion to $660 billion in new demand for Bitcoin And it's not from crypto bros, it is from wealth managers in Cincinnati rebalancing their portfolio before their afternoon golf. We don't need retail mania anymore because we are seeing compliance optimized, fee extracting, advisor distributed asset flow. So the second is that collateral adoption. So JPMorgan's tri-party repo structure means that Bitcoin continues to get recycled. Hedge funds can post BTC, the prime desks can reuse it, and capital efficiency goes parabolic because if you look at just 5% of JPMorgan's $700 billion securities-backed book, that's $35 billion in structural borrow demand, repeated, rolled, and reused across the entire repo lifecycle, which is long-term mechanical demand for the asset, no way around that. And third is the custody and settlements because banks can now generate recurring fee revenue from Bitcoin. If you want an incentive to promote an asset, give the banks a cut of AUC. At 20 basis points on $250 billion under custody, that's $500 million per year, recurring, very high margin, and very politically defensible. So now the banks have skin in the game. They want the ETF to grow now, and now they want Bitcoin to become more mainstream. And if you stack all of these three flows on top of each other, the ETF auto allocation, the collateral recycling, the custody revenue, what do you get? You get the most bullish perpetual structural bid in the entire history of Bitcoin as an asset. For years, we were speculating about this happening. Now it's happening in front of our face, not in a speculative manner. It's not cyclical, it is permanent. We're seeing the news coming out every other day about more Bitcoin acceptance because it is becoming the new monetary base layer that we thought it would. And it's not just being held by these people, it is being integrated into all of their services because the incentives are lining up. Okay, here's where the suit and tie risk models start to panic because once you plug structural flows into a fixed supply asset, the math doesn't ask for permission. You're looking at spot ETF liquidity, collateral velocity. This is what we call a monetary turnover. This is what the legacy markets, they call depth. And Bitcoin is starting to look like an asset with two-sided institutional liquidity. You get tighter basis spreads, you attract arbitrage capital, and you transform a historically thin, volatile market into a capital recycling machine. We are in unprecedented territory for Bitcoin. If we are conservative, let's say that only the ETF channel starts to get filled, just the low end of that estimate. Remember, I mentioned $330 billion. At current turnover rates, Bitcoin's float adjusted market cap would need to rise 40% just to digest that. And that's just to stand still. That is the new baseline and not the top. So if you're short the asset here, you are betting that hundreds of billions in persistent buy pressure somehow doesn't clear. Good luck explaining that to your LPs while Larry Fink buys your asks and rehypothecates your soul. But here's the real alpha when custody locks up the coins and collateral loops them through the tri-party repo, the float of Bitcoin shrinks, the volatility profile starts to die, and Bitcoin becomes sticky capital, held in cold storage behind custody APIs, rehypothecated in the repo markets, and rebalanced trapped inside ETF baskets. This isn't just bullish, kids. This is what happens when a new monetary asset becomes financially industrialized. The volatility is not going to disappear entirely because of this. It's just going to move from price to availability, and that, my friends, is when price becomes an auction for access. My name is Adam Livingston. I am incredibly bullish on Bitcoin. I hope you are too. Please like this video and subscribe to Swan because we bring you the daily Bitcoin insights during the greatest wealth transfer in the history of humanity. Have a terrific day. Do not party too hard. Class dismissed.